All right, you're good to go.
I think we're live.
Start.
Go ahead.
All right. Thank you all for attending today. We're really excited to talk to you about what we have planned for this year's CRE Summit this August. And we think this gives you a great snapshot of what's to come and a little bit about what's going on in the market right now.
Yeah, there's a lot. I think all of us in this business know the changes that are taking place and maybe have already taken place. And so we titled the summit this year, The Changing World of the CRE. What's it called? The Changing World of CRE. And just recently we added the word after changing, we put in parentheses, changed world. Because the more of our speakers that we talk to, the more we're finding that things have changed and are changing rapidly. And we're just going to touch the highlights today, like Chris mentioned, and give you a flavor of what's coming up. And we're very hopeful you'll join us in August 26th. You can register on the website, Attend CRE Summit. And we look forward to having you. I might add also that the pre-registration has topped all previous summits, the 32 previous years. Particularly, we're going back to 19, our last pre-COVID, pre-depression, pre-stock market crash, pre-interest rate, pre-Zoom. But we hit about 950, and already we've got about 450 pre-registered, and I think we have, Madison said 350 today on this call. So without any further ado, let's go to what we have determined to be, from listening to our planning committee, that the number one issue right now are these spiking interest rates. And with us today, we have Brett Michael, who is a VP commercial real estate lender from Pinnacle Bank. Brett, welcome. What's going on in the world of interest rates?
Hi, Jerry. Thanks for inviting me on here today. As you all know, we've seen a drastic increase in interest rates over the last handful of months here. The biggest thing is what you want to see. Madison, I don't know if you can get that thing to pull up that site. Let's see here. Yeah, what I just wanted to show, perfect, right there, is this is a good little snapshot. This is the Wall Street Journal's website today, live right now. But you can see the yield curve right now. The one on the bottom is 1 year ago, the black, and then the blue is our current rate environment right now. So if you look at that, we were right at about 1 year ago, about 0.9% on the 5-year treasury. And today you're at about a 3.2% on the 5-year treasury. Year to date, that has moved from about a 160 and the start of the year to about a 321 today, like I said. But the part that's, that you're seeing is giving all the alarm, which all your economists will point at, is we've got a very flat yield curve right now, which if you look at that, if you look from the 1 all the way out to a 30-year, you're not really seeing much increase. And actually right now, the yield curve is slightly inverted. You've got your 5-year was earlier today, and see if it still is right now, is slightly above your 10-year, which it is. It's 325 on a 5-year and 321 on a 10-year. So that's kind of an indicator of what we got going on here right now. But one of them, what I wanted to say is that we did see a drastic increase throughout the first part of the year here. Seems like that was a lot of it was the market expecting the Fed to maybe move 0.5% each of their meetings, and they did their quarter, and then they did 3/4, they did their half, then their 3/4, and now they're expecting probably another 3/4 bump. So the Fed fund rate is about a 170, is the 175 right now. Pardon me, my phone's ringing. And then the prime rate's 475, which there's a good chance in the next meeting here, I believe in next month, that might actually go up another 75 basis points. So, but it appears like the market's kind of, I think why they raised so quickly was that there is that the raises happened quicker than what they were expecting. But just to put this in perspective for everybody, I just ran some quick numbers. Everyone on here that's involved with real estate and everything else. So if you borrowed $5 million on a 30-year amortization and you had a 3.5% rate, let's say end of last year or current year, that payment's right about $25,000 a month, give or take a few dollars. If you take that same $25,000 a month, and I mean, let's just say that's what you can, based on cash flow of the property and based on current debt, that's all that the property can handle. Just simply alone, this shows what the difference in these rates with buying power has done. A rate today of say 5.5%, and that same deal, doing that same amortization, $25,000 a month, that only borrows you just under $4.1 million today. And then the same thing, all things, again, $25,000 payment, same thing again. And if you go up to 6.5%, your buying power is about 3.7 million. So that really shows, really puts in the hard numbers of the difference of just a 2% swing on rates, what that does to your property. I'm sure you can't, that 2% rate swing there. If it's a retail or commercial property, you couldn't adjust those. You can't be adjusting, lease payments as quick as you can. So maybe if you were you might have been in a 140 or 1.5 debt service coverage ratio last year. Now that same deal might be 1.25, barely kind of meeting the banking minimums. And one thing we were talking about here a little bit, we've seen, it seems like things have really slowed down a little bit. We've seen a lot of new deal flow for new construction ground up has definitely came to a screeching halt. The current stuff, that a lot of the stuff that is doing with stuff that's already approved, we're just kind of getting it booked. But a lot of new things right now, it seems like guys and gals and developers are sitting on their hands a little bit, just waiting, because they can't get the construction pricing to work with what to pencil out with what the current rate environment is right now too. And then also right now, probably the biggest thing we're seeing, one of the biggest things we're seeing is the exit risk for banks. So traditional banking, traditional banks like Pinnacle Bank here, we like to keep the loans as long as we can, as long as they're performing and making payments. But a lot of times we're in it kind of more on a short-term basis. We might be in a loan for 3 to 5 years. And if it's a new construction, we're looking at doing construction over 24 months, leasing up the property, getting it stabilized. And a lot of your developers are looking to take that loan to the permanent market as quick as they can. And the environment we're in right now, that's probably become one of our biggest risks and biggest concerns in our underwriting is being able to address that risk appropriately, where we were in a low cap rate environment, low interest rate environment, and you're penciling out a deal 3-4 years down the road of seeing what your exit looks like. Well, a lot of these right now, depends on the equity and everything else in there, but you might have, if cap rates move 1% up and rates go up by 1 or 2% or even 1%, and the cap rate moves, all of a sudden we could be underwater really quickly on these loans. So equity is definitely becoming a bigger talking point right now with a lot of these, a lot of loans we're looking at, is just because, previous deals, you could maybe get in with a little bit less equity or counting on the appreciation and going from there.
Great overview, Brett. Thank you for that. We're going to talk a little bit about the impact of these new rates when we get to Ember and some of his investment deals and what's going on. But right now, we're going to switch to Craig Callahan, who's the Chief Commercial Officer at Werner Enterprises, because the second most important subject our planning committee was concerned about is this continuing hangover from the supply chain. And Craig, welcome to CRE Summit, and we're delighted to have you, and we'd love to know what you guys are seeing at Werner.
Thanks, Jerry, and thanks, Chris. Appreciate the invitation. So yeah, that's a great segue. And I think Brett's introduction of the interest rate environment is certainly paramount. We probably pay a little bit more attention to what's going on in the world of inflation relative to consumers, because that really is what kind of shapes behavior. At least for us, we're very close to the consumption of goods. But let me just zoom out, and Jerry, I'm going to hit a couple of fronts. We'll start with supply. We'll talk a little bit about demand. I'll update you guys a little bit on the equipment environment, and then just maybe some thoughts on the outlook going forward, both near term and longer term. I think on the supply side, we would look at it. For us, that's really twofold. That's labor and equipment. And then, those two have to kind of mesh together to determine whether supply is, shrinking, growing, or staying flat. There's a lot going on right now. I think on the labor front, a year ago, if you would have asked me, I said we are in a labor crisis, and we were for a couple of years. That has stabilized a little bit for us. I wouldn't call us in a labor crisis as much as we were. We have a large network of truck driving schools, over 23 across the country, and they're branded as Roadmaster. So we get really good insight as to what's going on on the front end labor market relative to trucking. And our enrollments in those schools have stabilized, whereas a year ago they would have been decreasing. And then we're also seeing good interest and so those would be new people wanting to get into this industry as a profession. And then we're also seeing a little bit of an increase on experienced truck drivers that want to join Werner Enterprises, potentially from a competitor. And I'll more to that as we talk about the outlook. So I would say on the labor force, we're seeing some stabilization. This is not going to be a parade of any sorts. It is still highly competitive for us, especially in the truckload space. We're competing heavily with, what's going on in construction. That same demographic is typically who we hire from. And so there are some that labor continues to be bottlenecked in some respects. And then also we're just dealing with kind of the socioeconomics of the labor class, which, wants to be home every night. And so, jobs that don't allow for that are extremely hard to fill. Jobs like in the transportation industry that are home weekly are difficult to fill. Those that are home daily, much easier to fill, but home weekly or maybe even biweekly are extremely difficult to fill. So I would say, I would call it stabilizing. I would hesitate to call the labor environment easing. On the fleet sizing and on equipment, that is very, very constrained. The big manufacturers of equipment, so think about Freightliners, Peterbilt, Navistar, Kenworth. Those are the big companies that providing equipment, in all the big and heavy space. And in this particular case for Werner Enterprises, in the trucking landscape, for the last 2 years, every truck they could build, they could sell at a premium. And yet they've been unable to increase their build rates because of their own supply chain issues relative to raw materials and parts. And that is continuing. And we stay very close to those because they're big key suppliers of ours. We are a big believer in running a very new and modern fleet. So we're trying to buy 2,000, 2,500 trucks every year. That is extremely difficult to do. There isn't a company out there, even like Werner Enterprises at our size, that is getting 100% of what they order. Even though we might issue a PO for 2,500 trucks, we might get 80% of that by the time of the year ends. And think about the phenomenon of that as it trickles down to much smaller buyers in the space. So it is extremely hard to grow your fleet, even though demand is pretty decent right now, and it has been for the last couple of years. So those things I think are still going to be constraints on the supply side. On the demand side, all of our big clients, for example, are comparing themselves to record comps from last year. And then from last year, they were comparing to record comps from the year before because consumption has been so high over the course of the last 2 years as monies have shifted from services to goods. So we're starting to see that stabilize. And then also with just rising prices in everything we do and everything that we spend money on, we are seeing some cooling on the consumption And so, our clients are simply buying less because they're selling less. So think about the big retailers of the world. Now, there's still going to be winners and losers in that space. And I would just hesitate, you got to be a little careful about reading the headlines because consumption is down, but it's down off of record levels. And it's still well above the pre-COVID environment. And so that's just the comparable industry that we're up against. And then another key component that we pay attention to is what are inventories doing? So big retail companies and even CPG companies, the publicly traded ones, they'll report what their inventory status is. And that's a great read-in to what they're going to be buying. And then also what they're going to need from their key transportation and supply chain providers. And so for the last 2 years, those big companies could not keep up. They were selling more than they were buying. And so their inventories were depleting, which meant they were constantly putting pressure on their own supply chain and companies like ours to help us solve that problem. That is starting to ease. As they sell less, inventories are starting to stabilize. So there's not near as much hyperventilating, if you will, from our customers relative to needing goods moved quickly because they're not behind the 8 ball necessarily like they have been the last couple of years. So I would say that's stabilizing as well. Again, I would hesitate to call it easing, but it's certainly stabilizing from record levels of the last 2 years.
Craig, if I may interrupt
please.
you just for a sec. Let's say 100% was how far behind the 8 ball we were on supply chain. And you said it's starting to improve. Where would you say we are on that same scale now? And then what do you see coming in the next 6, 8, 10, 12 months?
I mean, I would probably go to the statistics, Jerry. Employment is up about 4% in our industry. That's a pretty decent sized number, right? If you think about, the millions of employees that are in supply chain. So I think, that looks like recovery, if you will. I would also say that on the pricing perspective, so if you just go to market and you want to buy services from a company like Warner Enterprises and you don't have a contract in place and you want to do spot work, those prices are down 25% from a year ago, still at levels above pre-COVID, but down 25%. So, we're still operating at elevated levels. Prices are still way higher than they were before COVID. Demand is at least as good, probably still a little bit better than before COVID. Supply is essentially at where it was going into COVID, probably still lacking a little bit. So I would say, we're probably, 20% improved. If you want to look at it, I would look at it as a lack of improvement because we like there to be a significant amount of demand. It's good for our business. But I would say there's probably a 20% delta there.
Is the trend line continuing? Do you see improvement down the road?
I think there's, depending on who you listen to, who you follow, the speculation is there's about a 50% chance of us entering, an economic recession. I would say specific to supply chain, be really careful about that. We don't think there's enough supply in the form of equipment that is going to help continue to increase the supply that's needed in trucks and trailers in order to make it work. And then one other thing, and it's clearly tied to, Brett's messaging on interest rates. If you think about the growth that has happened in transportation and logistics, much of it was fueled by demand that was way out in front of anything we've ever seen before. And so the barriers to entry in trucking are pretty minimal. You just need a CDL and a truck, and in some cases a trailer, and you can do that through financing. But the costs of that equipment, the secondary market of equipment, the last couple of years has been crazy. A truck that should have been selling for $35,000 was selling for $70,000 or $75,000. A trailer that should have been selling for $10,000 was selling for $25,000 or $30,000. We know this because we're the sellers. So we push all our equipment into the secondary market. And so we know what the market has been bearing. And if you're paying that much for equipment, and then the rates of the underlying work you're doing drop by 25 to 50%, the economics fall down in a hurry, especially when fuel is up 50% year over year. So the input costs are up significantly, plus the debt service that comes along with that, and decreasing revenue in the spot market where most of these small to medium-sized carriers live. Bankruptcies are already elevated, and we've seen that the last 2 quarters in data that you can track. And so I think that is going to continue to play itself out over the course of the next couple of quarters. And it's going to buffer, even though demand might be stabilizing, I think it's going to buffer some of the supply growth, Jerry.
Just one more question to kind of tie it specifically to real estate. The apartment industry, as you know, is on fire. Lumber went to 12, 13, 1,400, whatever, 1,000 board feet or whatever. And I guess it's down to 600 now. And I know a lot of that is exactly what you said, is that the mills, essentially shut down during COVID, and now they're coming back, and to try to get that all caught up, I guess it's starting to. But do you see goods that affect the CRE industry specifically starting to flow better?
Yeah, I think that's a fair expectation, Jerry. I think that, those factories have improved, right? Their output has increased as they've been able to stabilize their own labor and been able to get raw materials in. So I suspect that's improved. And then I think the underlying transportation, where some of that lumber was sitting for 7, 10, 15 days before it could get moved. That would not be the case today. Those things might be sitting for 2 or 3 days and then they're moving, because the overall industry is experiencing an easing in demand. And so I think that's a fair expectation that those goods they're going to get produced quicker, and they're probably going to get picked up and delivered quicker. We're not a big flatbed carrier, which is where most of that cargo would be moved, but it's all tied together. I mean, those companies will move around from flatbed to temperature control to dry van, depending on what the market's doing. And so I would think that that'll continue to ease going forward. I think that's a fair expectation.
Because that's been conversation, for the last couple of years, is on our projects, the timelines have just grown so huge. And that's, we hear supply chain, and kind of wondering at a certain point, does it become an excuse and an easy out? But you're telling us that you think that should be easy.
I think it should be easing. I think the thing that you have to watch out for is whether that's a near-term phenomenon or whether that will continue. I think there's a real chance that our industry, and I'm broad, but I'm talking about trucking, but I'm really talking about all of it together. There is going to be, I think, a ripple effect relative to some of the inflation that these small to medium-sized trucking companies, and that's basically who hauls goods like lumber and steel. Those are smaller companies, and they're going to have an impact of, what their cost structure looks like versus what the market is bearing for spot rates.
It already has, because as you know, construction pricing, which includes everything you just described, plus the raw material and labor, has jumped, 20, 30% just in the last 12, 18 months. And it's not only have the prices, construction costs increased, but now we've got the interest rates, which Brett touched on, and you sort of have those two worlds coming together, and it just means higher costs for our commercial real estate.
It is. Jerry, there's offsets, right? There's going to be trade-offs. I don't think that, there isn't $5 or $6 a mile isn't what it costs to move goods today, like it probably did a year ago. But there's other trade-offs for that, with rising interest rates and inflation in so many other areas that are probably going to more than offset that.
Anybody else have a question from our panel? Anything? Hey, Craig, this was just great. And we're delighted to have you, and appreciate your participation. Have a great day.
It was my pleasure. Thanks, you guys.
Craig.
You want to cover a few of the subjects that we are going to do this year at the summit? Please?
Yeah, so this is a little taste of some of what we're going to have at this year's summit. A couple of, well, let's see if that's going to be any, but you want to start here?
Yeah, that's fine.
So Ernie Goss is going to start our day and talk, with Creighton University. You probably heard him speak before, but we thought it really timely and really important that we have someone talk about the economics of what's going on in the world. So excited to have Ernie as part of the day. We're going to do, I have a follow-up on today's conversation with Nancy Predahl, who speaks a little bit later this morning. Nancy and I spoke kind of earlier in the year about all the changes and the things that are going on in the business world. Jerry and I had a lot of conversations about, are people going back to work? What does that look like? You guys have all had the same conversations in your office. And Nancy's got a really great lineup of folks that talk about what the changing world and our workplaces look like, how businesses are responding to this hybrid workforce. I think it's something most of us are dealing with every day with our clients, regardless of if you're an attorney, if you're in construction, or if you're a broker, what that looks like. So Nancy, I'll have a little talk about that today, but a really more in-depth and a great panel of folks talking about it in August.
And then I might add that after Nancy's panel, which is a major general session panel, we put together an amazing all-star group of lenders. First of all, we've got Holly Clark from First National and Kendra Ringenberg from Ringenberg and Ratner Law moderating this panel. We have Brad Hammett, Vice President of all mortgage lending at Mutual of Omaha. We've got Mark Wisdom, Executive VP at Pinnacle Bank, Jen Can from Great Southern Bank for a smaller regional bank, and John Reed, the Managing Director for Northmark. So we've got that cross-section of the whole lending group, and we're going to be talking to them next week. We have a session to kind of see where they're at. I think Brett Michael kind of touched on the most important points of that, but our goal here is to try to educate our whole commercial real estate community as to what's going on with rates. What we're really asking them is, what are the banks and lenders, how's their thinking changing or changed? Are they still willing to make loans like we have been so fluid in the last 7-8 years? Or are they getting more restrictive, or are they being forced to be more restrictive because of the example Brett gave with the amount of loan amount that you can no longer get, and therefore slow down of the deal. So I'm personally very excited about that for the summit, and we're really happy to have that kind of group put together.
And the next one is...
Yeah, I'm going to moderate a panel on multifamily just before lunch. We've got Josh Larson from CBRE, Sean McGlinney from Viridian, and Parker Stewart from Northmark again, covering the whole sort of waterfront of what's going on in multifamily. And we're going to touch on a couple of new concepts, including single family rental type communities that are sweeping across the country now.
And then we'll follow up. We added actually the next panel, which is the changing world of retail and how retail is rebounding post-COVID, partly because I think we were all a little surprised by it. I think retail had always been a session since I participated in CRE Summit, but it had been about the Amazons of the world and the closing of brick and mortar. I think we're seeing just the opposite. I think it surprised a lot of people that the pent up need for retail is so strong. Specifically Omaha, I think it's just, there's so many groups looking for it. We don't have a lot of vacancy in retail, and we've got a lot of pent up need for it. So Christy Anderson is going to moderate for us from Colliers. We've got panelists Lindsay Banks from Lockwood Development, Jay Heineman from CDRE, and Jared Sullivan from the Lerner Company. So we're really excited to hear about all the things that are happening in retail, and how I think it surprises us in this kind of post-COVID world that a lot of retailers are really busy and struggling to find spaces. Something we
learned last year was instead of talking about Chamber of Commerce issues, sort of high level esoteric things, everybody liked the fact that we had quality content last year, and we had really strong reviews on that. And we've tried to do that again this year. And I think we've accomplished it. I think you're going to come away from this summit with a much better education as to what is truly going on in our profession and what's going to go on in our profession. And it'll help you. I don't care if you're engineer, architect, developer, broker, lender, title, it will help you continue to understand and to move with our business as these changes come. So the whole day is flavored with the changing world. And one of the biggest changes is a breakout session that we're doing. We asked Amy Lauritsen from Baird Home to chair this because she's an expert in construction contracts. But you may know, a lot of you may know that the world of a guaranteed maximum contract is no more because of all the things that Craig talked about and the price jumps, and no subcontractor holds their prices for longer than 2 weeks or 30 days now. So we've had to modify construction contracts. And again, from an education standpoint, for you as a broker or developer or lender to understand what's needed today and what's practical under the current circumstances is very important. So we're absolutely delighted to have Amy chair that.
And then over the lunch hour, we'll have the Hall of Fame announcements, and those are coming soon. And then we've got a speaker, Amelia Rose Earhart is a pilot and a speaker and an author. She is named after the famous pilot, but she talks a lot about what we learned during turbulent times. And she's got some really specific examples from her own past, but we thought it just feels right. Like she puts a really great spin on moving through life during these kind of crazy times and gives us some tools to work through it. And that'll be over the lunch hour. And then after lunch, our first breakout session is specific to the commercial real estate world in construction and navigating labor shortages and choke supply chains and rising construction costs. Quinn Texmo, who's business development and marketing at Turner Construction, will be moderating that. We've got a really great panel here. She's bringing in Chief Procurement Officer for Turner, Mike Bruskin, is coming in to speak on her panel, as well as Tim Huber, the president of Overland Construction, and then Ashley Kuhn, president of Blair Friedman Group. So a very dynamic group of kind of alternate sizes of construction groups. And they'll be able to talk about what all of us are, I mean, even today's conversations have focused so much around construction and what the costs are and how it will be going forward and how we navigate the kind of the new real.
And that brings us to Ember Grummins, Investors Realty expert in investment property sales, who will have a breakout. But we also are delighted to have Ember with us today. We wanted to know, now that we've heard about rates and supplies and sort of a slowdown for this changing world in commercial real estate, Ember, what is going on in the investment sales world?
Well, thank you, Jerry and Chris. We've had a lot of changes here, and I think possibly more are coming. I think we're just at kind of the leading edge of the changes. So I want to go back here to January 1st. Brett talked about interest rates, very interesting. The rate that's the most meaningful to me in my practice is the 10-year Treasury rate. Most of the properties I work with get loans based on that rate, either a CMBS loan or a life company loan. So that rate was at 1.63% January 1st, and the market was the hottest I've seen in my career. We just saw incredible demand. It was kind of like a frenzy, and it concerned me because I remember when it got that way in 2007. Typically, when you have something just get too frothy, it's not good, and it's not sustainable. In particular, one product type that I've traded a lot of that had changed quite a bit. The suburban multi-tenant office has typically not had a lot of buyers, and cap rates just have tended to run higher in that product sector. And we saw several trades where these were at 7 caps properties that would have been an 8.25 here, several years ago. Also, we saw retail shopping centers improve, especially the larger ones. there's a COVID fear and those were trading at relatively high cap rates, prior to that, and a lot of concern about what Amazon is doing. And we saw those cap rates really drop on. So we just saw kind of a frenzy. And so you go back to now, the 10-year treasury is up 150 basis points, depending on what day you look at it, a little bit more, I think, today. And the cost to borrow for 10 years has gone from the low 4% up to the mid 5s. One thing I thought was interesting is I typically could count on, most of my world is a 10-year rate lock. I could count on a 5-year rate lock being 25 to 50 basis points less. Now that's the same rate, which is really, and that's that yield curve that Brett was talking about. So as this change started to happen, for a while, 2 months ago, I would have told you cap rates were staying the same. And we've had 2 major deals priced in our market that I consider a good benchmark. So the first deal would be the Shops at Greyhawk, which is the southwest corner of 144th and Maple. Lowe's is there, Michael's is the tenant there. Then there's 60,000 feet of shop space. First Watch is one of the tenants there. Everybody's probably driven by that center. So that was expected to trade in the low to the mid 7% cap rate range. And this went on the market, I think it was in March. So that traded in the upper 6% cap range, which is really, really, really low and less than I expected. Then we had another deal priced a little bit more recently. So 9202 F Street is a multi-tenant industrial building. It's an older building, and that was expected to trade in the low 6s. That traded in the very high 5 cap rate range. So we've seen up until recently cap rates stay steady. And what I heard from brokers is that they're seeing less buyers show up, but there were enough that did show up who were aggressive enough to keep cap rates the same. So that's what I would have told you probably 60 days ago. Now what I'm seeing is that individual investors are still strong. I'm working with some people on exchange now, and those cap rates have not changed that much. There's just a lot of buying power out there still, a lot of cash out there in that properties that are priced for that niche. The properties that are trading at higher price ranges, I would call those the professional buying class. That's REITs, it's private equity groups, and it's family offices. And that's where I'm starting to notice just here in the past couple of weeks, some pulling back. Some are put their pencils down and are not bidding. Some I had someone talk to me about, I said on my property, there's a 5.5 cap. He said, well, I'm looking at 7s now. So, and that's someone that maybe they wouldn't have traded the 5.5, but they would have been happy to get the property at a 6 cap. So it's very, very early, but I think those cap rates with the professional buyer class are starting to go up. I think the individual buyers will probably follow it. And I think that's what we're seeing. If you maybe guess at not a dollar amount of a percentage cap rate change, it's hard to do. It's going to vary, but I think 50 basis points higher on the professional buying class is probably probably a pretty good estimate. So that's what I'm seeing in my market.
Ember, the retrading deal that's pending, contract signed, have you seen buyers come back to and say, hey, my loan's much more costly now if you'll take $1 million less or something? What's going on in that world?
That's a great question. Jerry, I've not seen that yet. I'm working on a couple deals that I'm kind of wondering if that's coming. I know that when I'm working for the seller, I'm a lot more cautious about what interest rate is that decision based on, that pricing negotiation. What is their, what rate are they basing it on? When did they get their last quote? What's the lock on it? So I think that might be coming. I have not personally seen that yet.
Okay. But what about the velocity of deals? I think you said there are fewer buyers.
Yeah.
But yet there's enough interest. But is that velocity starting to go down?
I think it is, Jerry. I think that the buyers who are working on trades, finishing up trades is what I should say, are probably going to start to thin out a little bit. And I think that there's going to be some pricing disconnect. that if you could have sold here, you know, at a 50 basis point, 75 basis point lower cap rate here 3 months ago, it's very hard to pull the trigger on that. And so I think that we're going to see, I think there's going to see less properties offered because of the pricing expectations being lowered.
Yeah. And just learned this morning on our multifamily call from Parker Stewart, who does investment sales of multifamily, that velocity has, they have already seen a decline in that velocity, and yet there's still a tremendous amount of interest, as you know, in multifamily.
Yeah. That's interesting.
Yeah. I think that's great. Any questions? Anybody else? Fits very, very well. You want to introduce me?
Thanks, Ember.
Thank you. I appreciate it.
So next we have Nancy Friedel, who's President CEO at Lamprey Nearson. Nancy is going to give us a little preview of what she'll be talking about on the main stage at CRE Summit in August. Hi, Nancy.
Hello, everyone. So I've been asked to moderate a main stage session at the upcoming summit, the Changing World of CRE, and talking about how businesses are adapting to the increasing demands of a hybrid workforce while adding flexibility to changing markets. So we have a great panelist of experts coming to the table. Polly Harris, Assistant Vice President of Workforce Resource Services at Union Pacific. Jason Lorenzen, CEO and co-founder and head coach at Cultiveo. Hobson Powell, who's Vice President of Global Support at LinkedIn. And Alicia Radesha, interior designer and partner at RDG in planning design, and myself. So my talk is a little bit different from what we've been hearing. This is a little bit on the softer side, but it also really relates back to how we do business. So why is this timely right now? Let me start with our journey at Lamprey Nearson. We all know 2020 was a year unlike any other. What we knew was normal disappeared in the rearview mirror. And to build a bridge from what the normal we knew to what the normal of the future will be, we've had to ask ourselves some pretty tough questions about what we've learned from the unprecedented time in history. At Lamprey Nearson, we've done this by thinking like futurists. We're looking at signals of change and asking, what is losing or has lost its margin of return? What's emerging? And how do we plan to be a part of that? 2020 turned into 21, and then in 22. And like others, we faced challenges, yet we have not shied away from the wicked problems that come with complex, messy, and vague situations. Instead, we've held fast to our harbor of our purpose statement and core values. It can be challenging to drive meaningful change, but instead of steering away from our commitments of a community of problem solvers united to boldly forge forward, challenging the status quo, holding ourselves accountable, and making progress on achieving our purposeful objectives. So every year we set our charter for the year with an outlook. In 21, we jumped into leading with purpose with both feet. We felt that was really important for us to be thinking about for the future. And that set the groundwork for our 22, which is setting purpose in motion. Through purpose in motion, we continue to expand how we can leave a legacy by deepening our thinking around issues that will create value for our people and our communities. As our firm seeks to enhance our communities through the built environment, we fervently believe our teammates' success drives our business success. Establishing and maintaining a culture of belonging has required a shift from awareness to empathy and demonstrating inclusive leadership behaviors that cultivate trust among our colleagues. After all, our team members are our greatest asset. Today, we stand at the precipice of a new normal. COVID has become less of an immediate threat, we all hope, and the monkeypox doesn't become a new threat. But we also have this great resignation and low unemployment. There's still variables in hiring and staffing practices. The past several years have changed how people want to work, and even more so where they want to spend their time working. People are searching for a more profound sense of self within their lives. You've heard the YOLO, you only live once. And the traditional physical workspace isn't aligning with that sense of self, rather. There's a mass resistance to dutifully transition back to pre-pandemic working conditions. Many employees simply refuse to go back to how things used to be. In an irrevocably changed world, individuals seek to be authors of their new normal. So we must become intentional in the spaces we create for our employees to work and write their own life stories. Data has shown that remote work can boost productivity and curb burnout. Before the pandemic, many of us may have hesitated to allow their team members to work remotely. As the future of work paradigm shifted at an accelerated rate, more companies now realize how working from home can create boosted productivity. It likewise can help curb burnout. We can regard remote work as more than a solution to a one-time crisis. Remote work options enhance employees' well-being, productivity, innovation, and inclusion. One of our panelists, Jason Lorenzen, recently completed some management training for us at Lamper Nearson, and he said it well, and it was an equation, and engineers love a good equation. Employee well-being times satisfaction times drive equals engagement. Remote working options can create sustainable and equitable employee experiences and provide organizations the fortitude to weather wicked problems. To cultivate a diverse, inclusive, and satisfied workforce, we believe that we must develop our pipeline and create intentionality in our progression. If the office worker has fundamentally changed, then how we use the office space has also changed. Offices are becoming less of a space where workers push through their workday with their heads down. It's just not happening. Traditional office spaces are now more of a place where employees go to engage with their teams and their company brand in a way that cannot be replicated on Zoom. You see it with the registration of the CRE Summit. People want to be together in meaningful ways. The employee experience is an unequivocal differentiator when it comes to space. It's crucial that companies craft a seamless employee experience that is equitable for all, regardless of who they are, where they work, and what their position is. Rather than traditional in-office perks, employees are looking for equity, wellness, and purpose as a reason to draw them back into the office. And all that we do at Lamper Nearson, our core values drive us. We realize that our team's well-being and their viable office space options needed to be driven by a core value of fostering the development of our employees' professional, personal, and family lives. As our firm entered the pandemic recovery phase, we critically looked at our work, our progress, our journey, and transparency. We asked our people where we were falling short, where we're making the mark, and how we can improve. In creating Lamper Nearson's new working normal, we focused on the equity and parity of the experience for all of our staff. Our Lamper Nearson leadership team understood that in this watershed moment, we were likewise presented with an unprecedented opportunity to rebuild our work experience for inclusion while supporting employees in their life circumstances. If there's one thing the pandemic has taught us, is that we're all human with very human emotions. We must be tender in the care we take for one another while moving our businesses forward. It's not a zero-sum game. An empathetic and inclusive leadership style helps ensure our staff thrives and innovates. Another thing the pandemic has taught us is how to be agile. Since March of 2020, it feels like we've been a waltz of progress forward and strides back. The last several years have looked unlike any other, but we kept our focus on what we could control, allowing us to practice agility. We knew that we could control the research and development phase of our company's new working normal, and likewise, how we implemented steps forward.
Nancy, can I ask you a question?
Sure.
And I appreciate that's a great look at what's going on. We're all wondering, are people going to go back to work? I participated on an early call, and I think it was Alicia, yeah, from RDG, who does a lot of office, both reworking and new office. I think she's doing that medical thing at 192nd and R&R is the building out there. But what I learned from her was that they're reshaping, they're rethinking along the lines that you're suggesting. Are you seeing that as you put this panel together? Are you seeing that across the spectrum of office workers and what's going on in the office world?
So I think that the way to look at this is, how can we do this best? I don't know that everyone is doing this. I don't know that everyone is thinking about this. But if we bring the human component into how we think about what office space looks like, if we think about how we can implement this well, I've heard of some things that have gone really poorly for large firms that brought people back with not a lot of care, and then they had to start over. And so it's just really the intentionality of how you approach this work is what's so important. The space is important, the people are important. And that's why in our panel cross section, we have a coach, we have industry leaders in large organizations, we have the interior design specialist. It all has to come together, in my opinion, Jerry, to really be successful. You've got to think about the people, think about the space, think about your business.
So the takeaway for people that attend the summit from your main session panel, what would you expect them to take away? Let's talk about that, because this is sort of an appetizer for the session coming up in August.
So I think the main takeaway would be, what can you do in your organization? What ideas can you pull from our experts and our panelists that you can then take back to your organization? How can you approach it? How can you think about, how do we bring this workforce together for the future? And again, it's not everything works. It's not a one size fit all at all. Different organizations have different needs. They're different sizes, different teams. So it really is, I hope that the people can take back to their organizations, what piece of this makes sense for us? How can we look at this differently? How can we approach this with care and integrity so that we are bringing the best environment for our workforce to thrive? Because in today's environment, you have to have a place where people can thrive, but they're not going to stay.
That's just a great statement. And I appreciate you putting this together. I'm excited to hear what your team and your group have to say. And we're getting to the end. I appreciate everyone's participation. Nancy, thank you specifically for that and all the work that went into it. Madison, anything else we need? Are we missing anything? I think we might have covered it. Okay.
All right.
Yeah, I think.
And if anybody knows anything about me, if you participate in a meeting with me, I love them when they run short,
Yes.
not long.
No.
So we're about 55 minutes. I think that's enough. Interest rates, low cap. We talked about presidents discussed the
Oh yeah.
Yeah.
You mentioned that.
Yeah, go ahead and talk about that. Our final session of the day. Go ahead, Chris.
So the final session of the day, first, we're also going to have Jeffries, the president of the Greater Omaha Chamber, will come and speak to us at the end of the day for about 10 minutes and talk about the transition to a new president of our chamber, which we're really excited about. And then Jerry's going to moderate a panel of the commercial real estate presidents of the brokerage houses. We've got Jason Fisher, Bennett Ginsburg, Doug Grave Morrison, Kirk Hansen, Ting Langen, Mike Potoff, Jay Lerner, and TJ Twitt. So it's going to be a great panel. We'll talk a little bit about what's going on in that world. Kind of a dynamic group. Should be a lot of fun.
And then what's after that, Chris?
What's after that, Jerry? Then it's a short walk like last year, which ended up being quite well attended.
Oh my.
And we'll have happy hour afterwards. So at the Capitol District.
And rumor has it that 2 drinks are included
Oh, yes.
with your registration.
There's a complimentary 2-drink cocktail. And then Jerry will buy whatever else.
I'll
you
take
need.
the rest.
Jerry will buy whatever else you need. So if you haven't registered, please register now for Friday, August 26th. I think there's a few sponsorships left.
Yes.
And we can help you out there too. If you have any questions, please reach out to Jerry and myself.
Thank you all for your participation and those of you that signed in and listened. Take care. Have a good day.
Thank you.